So now we're going to be talking about when we have significant influence, we've bought enough of the stock, we own 20 to 50% of the stock, which means we have that many votes. So we have significant influence over the operations of this company. So this is a little bit different economic reality than when we have no influence whatsoever. So the accounting is different. So let's see what happens here. First of all, say Company A buys 25% of Company B stock for $180,000. So we would go stock investments, and usually if it's the equity method, you would put, say, 25% at equity, just so you know you're using that method. And we paid $180,000. Okay, so when, to simplify things, I'm just going to have all the dividends paid at 12/31, but if they were paid quarterly, this would happen each quarter. But say at 12/31, the Company B pays dividends of $60,000. Now that's $60,000 total dividends that the company is paying. So our company is going to get cash, but how much cash are we going to get? We're going to get that $60,000 that the company paid, but we only get 25% of it because we own 25% of the stock. So we would get $15,000. And so we got cash. And we are not going to call this dividend revenue, which you might think would be the logical thing to do, but because of the economic reality that we have significant influence over the operations and results of this company, and if we think about what just happened here, okay, if this is, if we're looking at Company B, they just paid dividends of $60,000. And so paying $60,000, if this is their retained earnings, they just reduced their retained earnings by $60,000. And so theoretically, since we influence this company, we're going to reduce our stock investment in that company by the amount, by our portion of the dividend. So we're going to do stock investments, 25% equity, and we're actually going to reduce our stock investment. Okay, that may not make intuitive sense, but it does if you think about it. Okay, now the other thing that happens is Company B says, okay, our net income for the year was $200,000. So obviously, if this is Company B's retained earnings, that just increased their retained earnings, $200,000. And since we have significant influence over the results of this, well, what we're going to do is we're going to increase our stock investment account in that company by stock investment be 25% at equity, and we would go 200,000 times our percentage, which is 25%, and so we would increase our stock investment by 50,000. Now, we're going to recognize revenue, and this is going to go on our income statement, even though, well, we haven't got any cash for it, we haven't got accounts receivable or anything. We're just going to go revenue from stock investment for our share of their net income. Okay, so when we say, and I'm going to go to Company A now, this is Company A, when we say that we are reporting these stock investments under the equity method, we're reporting them at fair value, or we're reporting them at equity on our financial statements. So Company A is going to have, this is their stock investments account, okay? And this is their, 25% at equity account. It started off with 180,000 when we bought it. It was decreased by our portion of their dividends. And then it was increased by our portion of their net income for the year. So if we go the 180 plus 50 minus 15, that is the amount that this company is going to be reported at our, on our financial statements at. So the 215,000 stuck here at the very bottom, that would be what would be on our balance sheet if we had stock investments, 25% at equity. That's the number right there. Okay, so that is our equity method. I'll just briefly talk about the consolidated method. If we own 50% or more, we have enough votes to determine whatever happens with that company. And so we file consolidated financial statements. Mercifully, we're not doing any consolidated financial statements, but you have to know that that method is used. The investor, our company, would be the parent company, and the company that we bought would be a subsidiary. So parent, subsidiary is, how that would be referred to. And the subsidiaries all still keep their own books and everything, but when it comes time for the accountants to prepare the financial statements, all of the subsidiaries that a company might own, all the results of those operations are consolidated into consolidated financial statements. Okay, so that's the consolidated method. We've got the equity method. We did the fair value method. So we're getting through Appendix C.